Greetings for the day, students. I, Professor Shaurya Shah, welcome you once again to the second lecture of Financial Management SYBBA Semester 3. I hope each and everyone is doing good. So students, in the last lecture, we had seen a brief idea of an entire semester. As I said, today we'll be starting with the second chapter, that is long-term investment decisions making. In that, we'll be studying the entire part of capital budgeting. As such, long-term decisions are known as capital budgeting. We'll be seeing a brief about the entire chapter, the introductory part, their characteristics, and the techniques for capital budget. Fine, shall we begin? To begin with, we'll be seeing first the introductory part of the chapter. What do you mean by capital budgeting, right? Why capital budgeting is necessary? Because once in business, when you procure the funds, then allocating those funds and investing those funds is very important decision in the business. Now, proper and efficient allocation of funds among different type of assets is the precondition for achievement of wealth maximization objective. Now, the funds which you have procured are to be invested either in fixed assets, either are to be utilized for working capital, or either are to be invested in current assets. So, those decisions regarding the investment in current assets are known as working capital management, as you can see on your screen. Those decisions which are regarding investment in current assets, that is your assets which are less than 12 months, they are known as working capital. In the last lecture we saw it in detail. What do you mean by working capital? Again, our chapter is concerned with the capital budgeting. Now, capital budgeting are long-term investment decisions. The volume of investment is also very high. It is for a longer period of time. We'll see when we discuss the meaning of that. But for that capital budgeting, you need to prepare an entire budget for making such kind of decisions. So for best capital budgeting decision, one has to make evaluation of each alternative. We cannot depend upon a single alternative. You need to verify, you need to calculate, you need to evaluate various kinds of alternatives, and then you can select one best alternative out of that. So that is known as capital budgeting investment. Fine. So moving on, students, I hope you must be clear with the introductory part of the chapter. So the meaning of capital budgeting, students, as you can see on your screen, the process of making the decision of investments of current funds in assets in anticipation of return during a series of future years is known as capital expenditure budgeting. Now, what is it? It is a process of making the decision of investment of current funds, the funds which you are having right now on your hand in your business, to decide whether to invest it in either current assets or either in fixed assets is related to capital budgeting decision. In anticipation of return, any investment you make, your main objective is to gain return out of it. So during a series of future years, it is not related to 1 year. Capital budgeting is for a longer period of time, right? So when you make a process of making the decision of investments of current funds which you are having in anticipation of return, it is known as capital expenditure budgeting. I hope everyone is clear with the meaning and the definition. Now, when you understand the definition, the following 5 points you need to remember for it. The very first thing, finding out of alternative investment opportunities. When you start your process of capital budgeting, the very first thing is to find out the best alternative you need to do. So out of a various options, suppose I want to invest in some factory, so I will take around 4-5 alternatives of factory decisions, where I would locate my plant, which plant will be most beneficial to me, which type of machinery to be invested, what will be the costing, what will be the return on investment. So I will decide, students, 4 to 5 alternatives first of all. Out of that, second step is to estimate the total investment in each case of them. What alternative, what costing and what investment I need to make. Apart from that, third step is to forecasting of cash flow during a series of year. Once I invest in the project, what amount of cash flow I'll be getting from each project during a period of year, because I will start getting return out of it every year once I invest in the current period. After forecasting, fourth is to evaluate each alternative by proper technique. In the later part of the chapter, we will be studying the various kinds of techniques of capital budgeting. How you actually do capital budgeting, that we are gonna study. And the last step is to selection of most profitable opportunity or the project. So finding out the alternatives, estimating the total investment, forecasting the cash flow out of it, and evaluating each alternative by proper techniques. You get the best alternative and the most profitable opportunity or the project. You select that project. That is the entire process is known as capital budgeting, or you can say capital expenditure budgeting. I suppose each and everyone is clear with the meaning of the capital budgeting. Okay, your entire chapter rests on this definition only and the 5 steps which we have seen right now. Is it clear, everyone? Fine. Moving on to the characteristics of capital budgeting, right? As you all know, characteristics, majority of the parts are cleared in your definition only, but we'll see one by one. There are around 7 major points in characteristics of capital budget. First of all, we'll see the head points, what it is, long-term investment, then large-scale investment, inflexibility, forecasting is essential, investment in present and income in future, risk of obsolescence, and planning of production capacity. Now, as I told earlier only, capital budgeting decisions are for a series of years. It is a long-term investment which you have made. It involves your assets which are acquired not for resale, but for use in business for creation of further wealth. You purchase such kind of assets. Once you built a factory, then you are not going to sell it again next year. You are going to sustain for a longer period of time. Once you purchase a capital asset, you construct a building. You do not construct building every year. You construct it for a longer period of time. So very first characteristics is long-term investment. Capital expenditure are for long-term investment. Is it clear? Fine. Second characteristics is large scale investment. As the word itself says, capital, you must be clear with the concept of revenue and capital. Capital are those balance sheet particulars which we write. Fine. So large scale investment. Capital budgeting is always concerned with investment in fixed assets, and fixed assets include, as you all know, land, building, plant and machinery, furniture, so on and so forth. And all these assets require a huge amount of investment, and it is always on a larger scale. Okay. Third, inflexibility. As it is for a longer period of time and it is done on a larger scale, the decisions which you make, particularly in capital budgeting, are fixed in nature. It cannot be altered or it cannot be changed, because if we change the decision, one has to pay a very heavy price and the entire investment can convert into a loss. Is it clear? So capital budgeting decisions are rather inflexible. Next is forecasting is essential. While making a capital expenditure, it requires forecasting of various matters. It includes forecasting of demand, forecasting of cash flow during a series of years, of future time period. It requires forecasting of future conditions. It requires forecasting of inflow and outflow of cash flow from the business. So forecasting is very much essential while you undergo capital budgeting decisions. I hope everyone is clear with first 4 points. Fine. Moving on with the 5th point. Investment in present and income in future. As the meaning itself says, you are using the current funds in current period. But as it is for a longer period of time, the result or the profit or the return which you are going to get will be for a longer period of time and will be coming in future. Immediately will not start getting the return out of it. So once you are investing the funds in present, and you will be getting the result or the output in future. Risk of obsolescence. What do you mean by obsolescence? Obsolescence means due to change in technology, the existing technology or the project becomes outdated. As and when technology progresses day by day, there is a great risk of assets becoming obsolete. So that is also a risk when you are doing capital budgeting. You are taking it for a longer period of time, and there is a chance that technology become obsolete and your project becomes outdated. So this risk is involved in capital budgeting. The last characteristics, planning of production capacity. When you do, students, prior to budgeting planning of production capacity, it is essential that estimate of expenditures depend upon production capacity. What is your production capacity? How much you are going to produce according to the demand or according to the consumer's necessity? This planning is to be done prior in advance. Then only you can consider about any capital project or any capital budgeting. Is it clear? Fine. So all 7 characteristics once again. First is long-term investment. Second is large-scale investment. Third, inflexibility. Fourth, forecasting is essential. Fifth, investment in present and income in future. Sixth, risk of obsolescence. And the seventh is your planning of production capacity. I hope every student is clear with the characteristics. Fine. Moving ahead to the methods of capital budgeting. This is another part of your chapter, a very important part. In your final exams, sums from this chapter comes especially for the methods and techniques of capital budgeting. So you have a list of methods which we had seen in the last lecture when we were discussing the syllabus. Fine. So you have around 6 to 7 methods. For each method you need to study the characteristics, working, merits, demerits, and a practical sum for that part. So we will be covering few of the methods in today's lecture, starting with the very first, that is accounting rate of return. Now all these methods are individually having their own merits, demerits, individual applicability according to the use of methods for production, type of project in your business. So we'll be seeing one by one. The very first method is accounting rate of return. Now how this method works? First of all, economic life of each project is determined. For how many years your project is going to work? What is the economic life? Say 5 years, 7 years, 10 years, 20 years is determined. Then the next step is capital expenditure required for each project is also estimated. What will be the total capital expenditure required for entire economic life of the project? And the third is net cash flow for each year is estimated. This all steps will be useful for you to do the practical sum. We are going to solve it after this. So net cash flow is determined. First of all, economic life is decided. Second, capital expenditure is decided. Third, cash flow is estimated. From this cash flow, provision for depreciation and interest on bonds, debentures is deducted. As you all must be aware with the term of depreciation, bonds and debentures, provision is removed out of the total net cash flow, as depreciation is also one kind of appropriation and amortization. Interest on debentures is an expense for us, so we will deduct it. After, what is remaining is profit before tax, PBT. From this amount, tax is again deducted and total of net profit of all the years is made. Suppose I am making an investment in 2020. My cash flow starts from 2020, 21, 22, 23. So for 5 years, I'll be adding my cash flows. And after that, divide this by the number of years. For 5 years, I have earned, suppose, say for example, 5 lakh rupees. So 5 lakh divided by 5 is 1 lakh. So what we get at the last is average annual net profit after interest, depreciation and tax. Keep in mind these steps very carefully. Just go through once again with these steps, because same steps will be useful to you to do the practical sums. What do? It is very easy, mind well students. A very scoring chapter. The sum will be of around 10 to 12 marks in your final exam. So if you practice it thoroughly, if you are clear with the concepts, it will be very easy for you all, because there are only 6 to 7 methods. Fine. So just go through it once again. First is determining the economic life. Second is capital expenditure. Third, cash flow is estimated. Cash flow. Then you deduct the depreciation. You deduct the interest on bonds and debentures. Remaining is PBT. In that PBT, you deduct the tax. Once the tax is deducted, you will divide it by the number of years and you will get average annual net profit. Is it clear, everyone? Fine. Moving on. How do you calculate actually? Once you have got the answer of average net profit, it can be calculated on the basis of these 3 formulas. Now these 3 formulas, there is no compulsion. According to the sum, we will be using various kinds of formulas. Seeing it briefly, first ARR. How do you calculate it? Average net profit upon average investment into 100. Average net profit, that is, you have found out in the sum. Just now only we saw the entire steps. You have got the answer. Then divided by your average investment. Now average investment, right, that we will be finding out directly in the sum. In all the three formulas, if you focus, the numerator remains the same, average net profit divided by original investment or divided by either average book value of investment, but always numerator will be average net profit. Denominator changes, but it remains investment only, method varies. I hope it is clear, everyone. Fine. Moving on, how do you calculate average investment, right? So for calculating average investment, there are two main formulas. There are around four formulas, but two mainly we use in practical sums. The very first, original investment plus scrap value. I hope all of you must be clear with the concept of scrap value, the value which we get at the end of economic life of the project, that is known as scrap value. So original investment plus scrap value divided by 2. Second, average investment is equals to original investment minus scrap value divided by 2. The entire answer you get plus net working capital plus scrap value. Now this depends upon the sum, which particulars are given in the sum. If nothing is given, only investment and scrap value are given, we will be using first formula. If net working capital is given, scrap value is given, then we'll be using second formula. I hope it is clear. So how to calculate average net profit, how to calculate average investment, then we'll be using it in the formula. Is it clear? We'll be looking forward to one practical example to understand this better. Just read the sum, students. Okay, what is being given in the sum? The estimated cost of project is 20 lakh rupees. At the end of 5th year, its scrap value is estimated to be 2 lakh rupees. It is predicted income before depreciation and tax during 5 years is as follows. So two things I can get out of it. The very first, estimated cost of project is 20 lakh. Can I say it is investment? Yes. At the end of 5th year, so I can say the economic life of the project is 5 years. Scrap value is 2 lakh rupees. Okay, so I am having two information with me, original investment, scrap value and economic life. I am having year wise income, that is cash flow. First year 5 lakh, second year 10 lakh, third year 12 lakh, fourth year 9 lakh, fifth year 6 lakh. And the corporate tax rate is 50%. Depreciation is per SLM. Fine. Depreciation is per SLM, straight line method. So you have 5 years life, you can calculate 1 year's depreciation. Is it clear? Everyone clear with the question first of all? Now how you have to solve it? Two things we require for ARR. First is average net profit. Second is average investment. Fine. Looking to the solution, I have again given the question in above the table. So the first column you can see is your income column, which is given already in the sum, the cash flow. What we need to do, we need to follow the steps. First of all, you are having the profit. After that you deduct the depreciation. Now depreciation is calculated how? SLM formula. You have cost, you have scrap value, you have your actual life for the project. So that is how you can calculate the entire thing. 20 lakh minus 2 lakh divided by 5 years. So you will be getting the answer of depreciation. As it is SLM, remains same for the entire 5 years period. In the third column, depreciation is deducted from the income. So 5 lakh minus 360 gives you 140. 10 lakh minus 360 gives you 640. 12 lakh minus 360 gives you 840. So on and so forth. So the very first step, always make a habit of preparing a table, students, in the exam also. Presentation wise also it looks good and it is easy for your calculation part also. Each method, remember the steps, remember the crux, remember the concept, then it will be very easy for you. So first of all, income I have written, depreciation I have calculated and I have deducted. That is gives me the income after depreciation. Once I get income after depreciation, as you all know, 50% is the corporate tax rate. So 50% I will deduct income after depreciation. So 140 into 50% is 70,000. 640 into 320 is 50% is 320. 840 into 50% is 420. So on and so forth. Once I deduct the tax, that is gives me profit after interest, depreciation and tax. That is last column, net profit. So what I'll do is I'll be taking into account this to this column. All the amounts will remain the same. And what I need to do is I need to total the entire profit. Why? Because I want to find out the average net profit. So what I'll do is I will remember the 12 lakh amount. What is my economic life estimated? That is 5 years. So as our step said, average annual profit, that is 12 lakh divided by 5 is equals to 2,40,000. So average annual profit gives me 2,40,000. Now second thing which we need is average investment. Now can I use which formula, students, in this sum? Are all the particulars given? Just go through the question once again. We have two formulas. One is original investment plus scrap value divided by 2, and the second formula is related to working capital. Now as such no information is given of working capital, I will use the formula number 1 to calculate the average investment. I hope it is clear, everyone. So for average investment we will be using the formula, particularly original investment plus scrap value divided by 2. So what is your original investment amount? That is 20 lakh. What is your scrap value? 2 lakh. So 20 lakh plus 2 lakh divided by 2 will give you the answer of 11 lakh. So what we'll do, we'll put up in the formula average net profit 2,40,000 divided by average investment into 100. So what I get is your average rate of return, that is 21.8%. That is your actual average rate of return. So when you are evaluating the various proposals, the proposal with the highest average rate of return you select, that project gives you the best option and the best profitability. I hope everyone is clear with the method. Fine, how you need to calculate it. This was just a simple example. We'll be solving the university sums once all the methods are done, so that your concepts are clear with each and every method. This chapter is very important from practical sums point of view, students. Fine. Now moving ahead, the merits of average rate of return method, that is your ARR. What are the merits? What are the advantages? As you can see, the very first thing, that rate of return reflects the earnings of entire period of economic life. Just now we saw what are the total earnings, what is the total profit you are getting. 12 lakh was the answer. So it provides a logical criteria that over a entire period of project's life, how much income or how much rate of return you are getting. We saw 21.8%. Another project is 25% or 30%. So the highest we will select, that will give you a logical criteria. Second point, it provides the standard for measuring the profitability of different projects. It gives the standard for measuring the profitability of different projects. There is a standard that higher the profit you can calculate, you have to follow the steps and then you will decide upon a project. So there is a standard for measuring. The third, it is easy to understand and work out rate of return. Once you have all the details, you have taxation, you have interest, you have depreciation, each and every calculations you can do, then it is very easy to understand. Next is necessary information for calculating rate of return is available from financial accounting system. All those information, you have to know the profit, you have to know the cash flow, you need to know the depreciation. So all those informations are easily available from accounting financial system. So you need to carry out with this things. I hope each and everyone is clear with this 4 merits of ARR method. Fine. Next is your demerits. What are the disadvantages or demerits of using this method? As every coin has 2 sides, this method is also having some of the demerits. Let's see, students. The very first, it does not take into account time value of money. In the last lecture, I gave you a brief idea of time value of money. What do you mean by that, right? 1 lakh amount, suppose for example I am getting this year. If I get 1 lakh rupees same after 5 years, the value has diminished. Though the amount and the quantum is same, but the value of money has again reduced. So it does not take into account. We take into account same time value of money every year. That is not so. So that will be covered in another method. Second is its reliability is doubtful as it is based on profit. Now profit What we are doing, students, we are calculating the entire amount on the basis of information given by accounting system. Now many a times it takes place that the company manipulates the profits also. They do window dressing. So if we take those figures as a base, then it is really doubtful that it is reliable or not. Third, it is not consistent with wealth maximization objective. Now when you want wealth maximization objective, you want to maximize your wealth in the business, it does not remain consistent with that, because as ARR only calculates the rate of return, it does not give any idea about in what year your wealth will be maximized and up to what extent. The next is, it does not take into account the differences in annual income. We are just taking the cash inflows and we are calculating on that basis, but we are not considering whether the annual income is increasing, decreasing, or no such effect is given in the practical sums. Next is, it does not consider the size of investment. The fifth point, size of investment doesn't matter whether it is 2 lakh, 20 lakh, 50 lakh. We are just putting it in a formula and we are calculating on the basis of your various rate of returns. Next is, rate of return with a project with a shorter economic life being higher, it will be selected. Definitely. Same 20 lakh if I am investing in a 3-year project, and same 20 lakh if I am investing in a 5-year project. So definitely the return will be higher in the shorter economic life of project. So when we compare the projects with different economic life, it becomes very difficult for us again to see whether the project selected is reliable or not. I hope it is clear, students. Fine. So just go through this once again. Demerits of ARR. Then we discussed 4 points of ARR. Merits. Fine. So out of this 6 methods which you are having, we'll have discussed today the first method, that is ARR. What we saw in today's lecture, we saw the introduction part of capital budgeting, then we saw the meaning of capital budgeting. Capital budgeting is related to long-term decision making of current funds which you are having with anticipating the returns which you are going to get. This is known as capital budgeting. Then students, we saw the characteristics of capital budgeting. There are mainly 7 points. You can again go through those points. After your characteristics, we started with the main methods and techniques of capital budgeting. The very first among that is ARR. Again, the methods we will be seeing one by one with one examples and your merits and demerits, and then we'll be continuing forward. So after that, we saw ARR, we saw the meaning of ARR, the process, how it is calculated, we solved the one sum for it, merits and demerits. Again students, we'll be continuing with the next lecture with rest of the methods we will be covering. Apart from that, next lecture we will cover most of the methods along with sums. Then we'll be starting with the university sums of this particular chapter with different methods. Again, I request each one of you, when you come for next lecture, revise this method, how it is calculated. Do practice this sum one more time with taking the question, analyze the sum for it, what elements are given, what are not. I hope everyone must be clear with today's part. We'll meet in the next lecture of your financial management. Thank you for your attention.